Ladies and gentlemen, we're kicking off a banger of a day in earnings. Got a lot of great companies to get to. We're going to start off here real quick with a little bit of Microsoft. You see overall reaction right now, pretty negative, down 2.5% in the after hours. Kind of shocked in that. I'm curious what that necessarily means, but in my opinion, I expected this company to beat. I expected to beat on both aspects based off of what they were estimated, but great company overall. And again, I think, as I mentioned there too, I think cloud strength certainly is a major part of this. I think right now this is a company that gets highly judged by the cloud growth number, how their platform's doing. And again, I think it's somewhat unfair in that aspect because due to, the law of large numbers, frankly, you can't present 60% growth rates consecutively for eternity. It doesn't happen. At some point, you slow down and you see growth rates will slow down. But in terms of dollar growth, you're still posting similar numbers. And the thing about these big hedge funds is they don't have any idea how to use their brain. They're really struggling in that aspect. The intelligence is not there. They didn't get a proper education. I get that, but that's okay. It's okay. Let's look at these earnings now, okay? Now, this is something I'm not shocked on. We zoomed in. We'll zoom back out. Don't want to be too close for you. I'm not shocked one bit here. A non-GAAP EPS line at $2.17 is a beat by 25 cents. I like to see that. We'll look what the net income looks like. And from a revenue perspective, $46.2 billion is up 21% year over year, which is a massive number because it's a beat by $2 billion over the estimates. That's entirely what I told you to expect. Look, I think a lot of these companies got very soft estimates for this year. I think it's mostly because they knew comps would be tough, but I'm not shocked at all by this number here. I mean, this is a company I expect they're doing fantastic numbers. The video game industry's been incredible for them. Cloud platform's still doing fantastic numbers. I don't know. I just don't know what analysts were expecting here, but obviously not good estimates, that's for sure. Let's take a peek at this press release, look a little bit deeper into what we got here. We saw that revenue line looking good. Operating income came in at $19.1 billion. Net income at $16.5 billion, increased 47%. Now, larger increases in net income, not a shocker. There were a lot more expenses that were associated with last year, but this is significant. Net income of $16 billion off of a revenue of $46 billion is incredible. That's an incredible increase of cash there. The way they're able to talk about the profit line there. Good golly, net income. That's what you're looking for out of a company you want to invest in. It's that. Not only do you have growth here of significant numbers, when you're talking about double-digit growth, we're talking about 20+% growth off of a fantastic year last year, which was significant. You're talking about a ridiculous net income line. That's nice. That is really nice. Very happy about that. Some of the business highlights here, they'll mention revenue and productivity and business was up 25%, with some highlights here being the Office commercial products and cloud services up 20%, driven by 365, commercial revenue up 25%, so businesses using Office 365. Good to see that aspect. Obviously, you should get people on board with that. Office 365 is obviously significant for them because it offers a subscription platform rather than what used to be a one-time buy of the Microsoft Office suites for a single PC or laptop, single device. You'd buy a lifetime product, but now with Office 365, you're allowed up to, depends on what membership you're in, but I believe it's 4 devices base, and you pay for the year for Microsoft Office, which I kind of like. Some people don't necessarily need it for the life of the device, and sometimes the life of the device is, 5 years, 4 years, and you'll have to buy it again. So this subscription platform, I think, makes a lot more sense. They might need it only through college. They might need it whatever it might be, but it makes a lot of sense to me. Consumer products and cloud service revenue up 18%, led by Microsoft 365 because of growth to 51.9 million subscribers. Again, subscription revenue nice. LinkedIn revenue up, which is nice. Marketing solutions growth of 97%. Again, I think that'll be a huge aspect for them. how they can monetize LinkedIn and what it's able to do. But I think it's a significant platform, especially for people seeking professional careers. It's pretty significant, in my opinion. I think it's going to be massive for them. So Intelligent Cloud, this is the number that a lot of people are looking at. $17.4 billion, increased 30%. Some of the business highlights: Azure up 51% is actually pretty significant. I didn't even anticipate a 51% growth in this cloud platform in this aspect. Obviously they used to be doing upwards of 67%. Every single quarter. It's not a shocker it's fallen, but I thought it'd be around 45. So to see 51% here is pretty darn nice. 45% in constant currency. See, I was right in some way. But nice to see that. More personal computing, see what devices look like, as well as gaming. 14.1 billion is up 9%. Again, this is a really tough comps from last year, so I'm not shocked this segment wasn't necessarily up as much, but to see an increase is still significant. Windows OEM revenue decreased 3%. Not crazy in that aspect. Commercial product and cloud services up 20%. Xbox content and services decreased 4%. Again, I think that's because we just had an absolute record year in terms of overall in terms of video game industry. The video game industry was popping off last year to an intense degree, so I'm not shocked it was a slight decrease. Search advertising revenue increased 53%. Again, ad revenue is, ad rates have gone up significantly. You've seen that with the social media platforms that have reported already. Good to see that. And service revenue decreased 20%, so you'd like to see a little bit more in terms of that, but overall the segment, not too bad. They returned $10.4 billion to shareholders in the form of repurchases and dividends in the fourth quarter. For the full year, they grew revenue 18%, operating income 32%, net income came in at $61 billion for the year, which is incredible on a GAAP standpoint, increase of 38%. Beautiful, beautiful stuff. That's crazy to bring up that much net income off a revenue of 168. That's top tier. That's top tier company right here. It's absolutely top tier. You can't lie to me. Let's see if we can sneak a little balance sheet out of this company. That's what I'd like to do. And we do. We're going to sneak it out. I mean, that's what we do. We find a balance sheet. We hunt it down until we get it. And we're going to get the balance sheet. So right now, you see a comparison full year over year. I love it. I love when it's a year over year. Total cash and cash equivalents. Nice to see that. But total current assets is what we look at. But, that's fine. Total current assets 184.4 compared to 181.9. So a slight increase there, mostly just due to a growth in this cash position. But you saw a decrease in short-term investments. So we also saw more in accounts receivable. Good to see them. They'll be, receiving those accounts. That's nice. Total assets in general saw a much bigger increase at $333 billion compared to $301 billion. Big growth here, really in property. So that's the significant number there for you. Liabilities. That's right. We saw an increase. Total current liabilities at 88.6 compared to 72.3. So much larger increase in current liabilities due to an overall growth in short-term unearned revenue, which obviously I think in my perspective they'll make that back pretty easy. But overall, you look at it, they paid off long-term indebtedness this past year, $191.7 billion in liabilities compared to 183. So you grew assets by quite a bit larger. And again, due to the just significant model here with this net income line, I feel good about that. Stockholder equity at 142 compared to 118. I feel really good about where the stock's at right now. I can't believe the stock's down in after-hours trading. Again, market cap's high on this one. We're talking about a $2 trillion market cap. So overall, it's a company that's valued pretty high. We're talking about this year they'll likely, if you compare it to what they did full year this year, it's a fair way to judge them. $168 billion. So trading in a market cap of over $2 trillion, it's pretty expensive. I won't lie to you there. We're talking about right now, around 15 times that value, which is pretty expensive. From my perspective, I believe the stock is valued very high right now, but I think it's one that warrants it. And I think a lot of it's just due to recent run-up. I mean, we're talking about 41% growth in the last year, but really since their dip in March of last year, growth of 100%, which isn't crazy compared to the general market. But again, I still like this stock as a buy and hold very, very, very long term. Very long term. I'm telling you, you're going to hold this thing for 5 to 10 years and you'll be very happy with yourself, even at these valuations. And maybe this stock dip in after hours, if it sticks to the morning, might offer up an opportunity for you to get in. Obviously, I'm in it at quite a low level, so I'm happy with that. Pays a dividend that will continue for sure, and they'll continue to increase it. So I like this company a lot. The cash they're able to produce is unmatched. I mean, it's incredible. That's what I got for you. Hope you enjoyed.